Investors and financial experts alike rank Warren Buffett among the top achievers of all time. The CEO of Berkshire Hathaway, also known as the Oracle of Omaha, ranks 5th on the Bloomberg Billionaires Index with a net worth of $107 billion. Although he has built a reputation for being able to read Wall Street like a book, the billionaire has admitted to having made several poor investments in the past. Buffett has discussed his biggest investing mistakes in his legendary annual letters to Berkshire Hathaway shareholders many times. In this video, we will talk about the biggest investing mistakes that Warren Buffett admits he has made in his career. So stay with us till the end of the video to understand these mistakes and avoid making them in the future. Number 1. Berkshire Hathaway. Shocking, right? Warren Buffett called Berkshire Hathaway the dumbest stock he had ever purchased in an interview with CNBC in 2018. Buffett said Berkshire Hathaway was a failing textile company when he first invested in it in 1962. He bought a lot of shares at the time because he anticipated a profit from the closure of additional mills. Later on, however, the company attempted to squeeze even more money out of Buffett. Buffett, in a fit of pique, bought out the textile company, fired the manager, and fought to keep the company afloat. The billionaire estimated this emotionally driven action cost him $200 billion. The takeaway here is to keep your emotions in check when making major financial choices. Number 2. Dexter Shoe Company. Warren Buffett paid $433 million in Berkshire Hathaway stock to acquire Dexter Shoe Company in 1993. Due to Buffett's mistaken assumption that Dexter's competitive advantage would last forever, his investment in Dexter Shoes was disastrous. Buffett said, "What I had assessed as a durable competitive advantage vanished within a few years. This bad decision, according to the billionaire investor, cost his clients $3.5 billion. So what can be learned from this is the importance of checking a company's long-term competitive advantage before making an investment. Number 3. Using Berkshire shares to fund the Dexter Shoe purchase. Buffett has expressed another regret about his purchase of Dexter Shoe Company. He was unhappy with his method of paying the $433 million purchase price. Back then, Buffett paid for the deal using Berkshire Hathaway shares rather than cash. These stocks were worth $5.7 billion at the time. Buffett said, as a financial disaster, this one deserves a spot in the Guinness Book of World Records. Tesco investment. Berkshire Hathaway owned over 5% of the UK-based grocery chain Tesco by 2012. Tesco had problems by 2013, so Berkshire reduced its shareholding to 3.7%, representing approximately $1.7 billion. Tesco's share price dropped significantly over the next few months. Sales dropped roughly 50% owing to discount retailer competition. Accounting scandals occurred simultaneously, and UK banking regulators investigated the company. Buffett's mistake was delaying Tesco stock sales despite seeing troubling signs. The delay cost Berkshire $444 million. It means selling requires conviction. Holding a stock without conviction is like investing without conviction. Number 5. Buying stocks in US Air. In 1989, Warren Buffett was impressed by US Air's rapid revenue development and made a purchase of preferred stock. Sadly, the investment immediately went south because US Air failed to generate sufficient profits to cover the dividends owed on the stock. The stock never went up in value, but Forbes said the expert investor most likely got all of his money and dividends back after the market turbulence subsided. He attributed the airline's turnaround to his and Munger's departure from the board and CEO Stephen Wolf's entrance. This error teaches investors to investigate every investment before buying. Number 6. Not buying Amazon stocks. When asked why didn't he buy stock in Amazon, Buffett said, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has. Obviously, I should have bought it long ago because I admired it long ago. But I didn't understand the power of the model as I went along, and the price always seemed to more than reflect the power of the model at that time. So it's one I missed big time." When investing, Warren Buffett typically avoids businesses he knows nothing about, which was a mistake in this case, so never ignore a potential investment because you don't understand it. Number 7. Not buying stock in Google. There is not a single share of Google stock in the Berkshire Hathaway portfolio. This is something that Warren Buffett regrets very much. Berkshire's subsidiary Geico was the first thing that made Buffett notice Google. The business is related to car insurance, therefore it places a high priority on Google's advertising system and its quest to attract new customers. Buffett now realizes he should have had a better grasp of Google's company and long-term prospects. The missed opportunity may have been caused in part by Buffett's lack of technical knowledge. Number 8. Lubrizol and David Sokol controversy. Warren Buffett and Berkshire Hathaway came under fire in 2011 after it was revealed that David Sokol, then chairman of several of the firm's companies, had pushed Lubrizol Corp to Buffett as a potential purchase. The issue was that Sokol had stock in the chemical firm. After Berkshire's $9 billion acquisition of Lubrizol, Sokol's profit was $3 million. He violated insider trading rules by not disclosing his shares of ownership to Buffett. At the Berkshire Hathaway annual meeting in 2011, Buffett confessed that he should have questioned Sokol further but didn't understand his error at the time. So investment advice here is that trusting too much is bad. Number 9. Energy Future Holdings. In his 2013 letter to shareholders, Buffett explained his Energy Future Holdings fiasco. The equity owners invested $8 billion and borrowed additional funds. Natural gas prices fell from the 2007 level. Energy Future lost heavily and went bankrupt in 2014. In 2013, Berkshire sold $2.1 billion in bonds at a loss of $873 million USD. In the letter, Buffett wrote, "About $2 billion of the debt was purchased by Berkshire, pursuant to a decision I made without consulting with Charlie," referring to Charles Munger, Berkshire Hathaway's vice chairman. Number 10. Purchasing Wambeck Textile Company. 13 years after Buffett bought the struggling Berkshire Hathaway Textile Company in 1962, he bought the bankrupt Wambeck Mills. Buffett admitted that buying Wambeck was a bad idea, saying that Berkshire closed the mill not long after they took ownership in 1975. The takeaway from Buffett's failed investment in Wambeck is the importance of reflecting on and correcting past errors. Number 11. Not buying the Dallas-Fort Worth NBC station. Buffett mentioned the opportunity to buy Dallas-Fort Worth NBC station around the time he purchased See's Candies in 1972. In his 2007 letter to shareholders. While he trusted the offer's originator and recognized the opportunity for substantial development with minimal outlay of initial funds, he ultimately decided to pass. So the lesson here is to grab the opportunity when it presents itself. Number 12. Issuing extra shares of Berkshire Hathaway to buy General Reinsurance. When Warren Buffett bought General Reinsurance in 1998, it was not the best move for his investment strategy at first. Buffett turned things around, but he has some regrets about what he did. Buffett wrote, "After some early problems, General Re has become a fine insurance operation that we prize. It was nevertheless a terrible mistake on my part to issue 272,000 shares of Berkshire in buying General Re. My error caused Berkshire shareholders to give far more than they received." So the lesson is to fix your mistakes the right way, and you can enjoy the benefits of success. Number 13. Not doing the right amount of research before buying General Reinsurance. In his 2001 shareholder letter, he elaborated on the reasons behind Berkshire Hathaway's loss in General Re deal. Among them were underwriting losses, failure to account for the potential for terrorist attacks, and the realization that Gen Re did not have sufficient reserves to cover losses suffered by older insurance. In 2001, Berkshire Hathaway lost $800 million due to the deal. The takeaway from this is to verify the figures and consult with many experts. Number 14. Buying a lot of ConocoPhillips stock. In his 2008 shareholders letter, Buffett wrote, "Without urging from Charlie or anyone else, I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year." Buffett bought 85 million ConocoPhillips shares for $7 billion, although their market value at the time of the letter was just $4.4 billion. Number 15. Miscalculating the return on investment for some industrial service and retail projects. While highlighting the depth of Berkshire's manufacturing service and retail divisions in his 2015 shareholder letter, Warren Buffett admitted that the company's portfolio includes certain companies with bad returns, which he views as severe blunders. Buffett wrote, "In most of these cases, I was wrong in my evaluation of the economic dynamics of the company or the industry in which it operates, and we are now paying the price for my misjudgments. At other times, I stumbled in evaluating either the fidelity or the ability of incumbent managers or ones I later appointed. So this was all about Warren Buffett's 15 investing mistakes. Make sure to avoid these mistakes while investing in the stock market. I hope you enjoyed the video. Keep the comment box ticking with your opinions. Thank you for watching, and we'll see you in the next one.